Good morning, everyone, and thank you very much for joining me. This is the Morning Market Review. Thursday, the 6th of October. My name is Russell Shaw, Senior Market Specialist at FXCM. I'm just going to bring up the high-risk investment warning. And just want to double-check that you guys can hear me and see the screen. Just confirm we're good on that front. Excellent. Bringing up now the market commentaries disclaimer. And just going to bring up the references, MarketScope, TradingView, and of course the Bloomberg emails. We'll just go through the five stories that are driving the day. Just before we get onto that, I want to remind everyone we've got the third workshop today in the day trading course. And then tomorrow we're going to do the live NFP trade, live account. And I have put the registration for that in the chat. Everybody is certainly welcome. I'm going to go ahead, just bring up this chart just to have it on the screen while we go through the email. And then we'll do some analysis. Hey Anna, nice to have you on the webinar. Thanks everyone for joining. Nice to have you all logging in. All right, so the 5 things to start our day. This is from Bloomberg. The first headline reads "Dangerous Game." Dip buyers wagering that the era of central bank hawkishness has peaked. These guys got a reminder Wednesday that they're playing a dangerous game. The S&P 500 sank as much as 1.8% after the biggest 2-day surge since April 2020, drew in traders tanked up on newly dovish monetary bets. While the index clawed back most of the losses, would-be bulls were put on notice as Federal Reserve Bank of San Francisco President Mary Daly disabused notions that a policy pivot is in the offing. Federal Reserve Bank of Atlanta President Raphael Bostic echoed Daly's comments, saying he was not advocating a quick turn towards accommodation. From our point of view, let's just be clear the way we're interpreting the situation. The real rate and yields are overbought. It's a hot market. It's due a correction. Prices don't move in a straight line. They ebb and flow. There's that natural zig and zag. That's just normal price behavior. Until we see some sort of pivot and moderation in that sticky inflation, in that median, I think any talk of a Fed pivot is completely premature and has absolutely no standing. That's the way I would suggest we look at it. The second headline reads oil price cap. Russia could cut its oil production by as much as 3 million barrels per day if the European Union and US proceed with a plan to cap prices. Market experts have warned. The comments come as EU countries on Wednesday reached a compromise on a new package of Russian sanctions, and as OPEC Plus nations, including Russia, agreed separately to cut production and support global prices. The EU pact includes support for the price cap on oil sales to third countries. Speaking after the OPEC Plus announcement, Russian Deputy Prime Minister Alexander Novak reiterated that his country won't sell oil to any countries that adopt such a cap. Third headline reads, attacking Truss. UK Prime Minister Liz Truss is facing a fight to survive. She had arrived in Birmingham for a Tory conference, determined to mark the end of a difficult first month in office by stamping her authority on the ruling party. Instead, she was often hidden away in desperate private meetings as her opponents worked openly against the government and her cabinet squabbled in public. Truss herself asked the party to judge her a year from now when her growth plan has had time to work, but she may not get that long. Adding to the grim future is Fitch, which lowered the UK's credit outlook to negative from stable. Next headline, Musk and Twitter. Elon Musk won't be showing up Thursday for a long-awaited deposition in Twitter's lawsuit aiming at forcing him to go through a 44 billion buyout of the company, according to people familiar with the matter. The billionaire reversed course earlier this week and committed himself to consummating the $54.20 per share offer for the popular social media platform on its original terms, which seems expensive, right? Even though the deal still may take months to close, a trial set for October 17th is almost certain to be put on hold. This means there's no pressure for Musk to submit for pre-trial questioning about his complaints that Twitter executives hid the number of robot and spam accounts. I would also argue that it's not just Twitter, by the way. If you just go into a YouTube channel and you follow the comments in the YouTube channel, more often than not, you'll spot just dozens and dozens of bots there, you know, usually linked to Bitcoin. All right, another one leaving. Credit Suisse's Christopher Chua is joining a wave of departures from the embattled firm. Chua, who was a Hong Kong-based managing director and deputy head of mergers and acquisitions for Asia Pacific, left the bank to help oversee the Asia mergers and acquisition business at HSBC. People with knowledge of the matter said. Credit Suisse has become a poaching ground for rivals in recent times, with the lender struggling to contain the fallout of a series of scandals and flagging performance. It earlier lost its Asia deputy wealth head. The bank is due to unveil a strategic review this month that's expected to include large-scale investment banking retreat. All right, so that's the news. Just the last thing I think we should read. European shares are set to follow their Asian peers higher as investors keep the faith in stocks. Even as traders weigh the impact of rising oil prices on inflation, the ECB publishes an account of its September policy meeting. Fed speakers Charles Evans, Lisa Cook, and Loretta Mester participate in separate events. All right, let's take a look at the real rate here. This is the daily chart. Let's perhaps take this out. Let's take a look at the daily chart with let's throw in some indicator. So the first one we'll put in would be the RSI, just to get a sense of how overbought the market is. It has corrected on the daily, so let's just bring that up. Okay, so you can see that it's normalized. Let's throw in a Stochastic as well. Okay, and let's throw in the US dollar with that, and we'll take a look at it on a daily, and then we'll move to the weekly. Okay, I think we've got a fair amount of information here to work with. So first thing is that we're not overbought daily anymore. Okay, so this overbought condition has now corrected. I think that certainly is something that is worth acknowledging, because overbought conditions will put in, one would think, a price ceiling, and then the fact that it's normalized actually now lays platform for the next impulse move up. So what we are really looking at here this is the reference candle, and we're going to discuss this in our day trading today. There's the reference candle. Yesterday we had price closing above that reference, and there's a potential lower trough that's come in. So if that's the lower trough and overbought, then we have certainly scope for higher prices on the daily. However, just switching to weekly, and then I'm going to come back to the daily. I think the weekly does have some clearing out here still to do. So the weekly, I think it's actually slipped perhaps slightly below that key level, but I wouldn't be surprised if the weekly needs some more normalization. We'll come back to the weekly in a moment. All right, so we've got this potential higher here. I'm going to close out the RSI. We don't need it anymore, right? We can see we're not overbought. All right, let's take a look at Stochastic. So Stochastic, where you can just see the momentum here, right? This is just absolutely devastating momentum of risk. You can see that as the Stochastic stays in that upper quintile, it's being absolutely representative of the underlying momentum in real rates. It has pulled back, slipped, so the momentum has waned. Now, what would be interesting from this analysis is, okay, so we've got a higher trough coming in. Are we going to get another peak? Well, the stochastic here is going to be instrumental in helping us with that. In other words, we want to see if it gets back into the 80 holds. If it gets back into that 80 and holds, that's bad news for stock markets right there. Okay, what's happened to the US dollar? US dollar's pulled back as the normalized. Well, that normalization process is done now. So one would think this is a dip to monitor. The obvious, is this a dip in an uptrend? Is this something that is notable? We don't quite have the reference candle over here. I don't see the, so we haven't got the higher trough in yet, but it's worth just keeping an eye out to see you get that higher trough. In other words, is it taking its cue from the real rate? And if it does take its cue from the real rate, then we move from risk on back into that risk off, and the dollar laying the groundwork for higher prices. If that's the case, then we see pressure on the majors. We'll see pressure on the risk. So just very interested to see how we end the day. Now, let's just zoom into the last two candles here on the US dollar. So this can use as the reference. Okay, what I mean by the reference? Lowest low in at least 3 candles. If that's, then it's high, the line in the sand. And if you get a strong blue candle today, and it's out yesterday's high, well, then we've got the higher trough in, and that is needed if there's going to be a swing. Well, it can't happen without the reference candles, right? So just want to see if we do get the reference candle here. So I don't know if the dollar is going to swing. Nobody knows if it's going to swing, even if we get the 3 conditions met, or the reference candle, which again, just to reiterate, we're going to discuss in depth today in the workshop. However, what I can say is with the reference confirmation, there is no chance of a swing, okay? Because all swings must have reference candles in it. That's what makes it such an important and powerful chart pattern. So we've got it on the rate, but we don't have it on the but I think it might take its cue. All right, let's just take at a few other charts here. Let's bring up the main layout. All right, I'm going to just bring up DAX here. All right, so top down. So you can see here that the moderation in the real rate has really led to a strong movement on the risk markets. That's something that we actually were ahead of that, right? It's something that we suggested, look, real rates overbought. If they do pull back, and they have started pulling back, risk markets are going to benefit. Well, that's exactly what's happened. But the next part of this is, well, where's the next peak? Okay, is it going to be a lower peak, or is it going to be a higher peak? So I'm going to put in an LP question mark for us to monitor. When there's a question mark, it's not. It's still being assessed, right? We're still in. So if this lower peak here, then the downtrend effectively ends, but it doesn't put us into uptrend. Uptrend will need the higher trough higher, but very strong week. And I'm a little bit surprised by how quickly the market actually did correct, did push prices up. There's obviously a lot of people that are looking for bargains at the moment. So when we do get the co-block picking up, and we see that there are certain signs of a pivot, for example, that median inflation moderation, then I think the next bull market probably has a huge amount of potential. But I'm not sure that we are there yet. Gerdieb's asking if there's some sort of short squeeze here, and it's certainly a likelihood. So what a short squeeze would be. So if you wanted to take advantage of the DAX, you've got to the downside to the DAX, you've got to go short. One of the ways to go short is that you actually would borrow stock, and then you'll sell it into the market, hoping to buy it back at a cheaper price, settle your liability and keep the profits. What a squeeze effectively is, if you've got so many people that are short, and the actual financial institutions that have the stock to lend out actually stop lending it out, right? So you can't borrow anymore. So that in of itself would foster actually bids, or foster bids, because the supplies dried up. So this could certainly be some sort of squeeze there. I haven't read anything to that effect, by the way, but it's good if it is. The idea here is to keep an eye on that real rate. As much as we want to see the value kick in and really see bargains out there, I think the whole cause and effect, well, it all starts with that real rate, right? And I think we've got to be just cognizant of that. If you go through to the daily chart, yes, it's gapped up and it's in neutral area. The stochastics moved out of that lower quintile, right? So there is some sort of movement to the upside. But what's the danger here? And I would suggest the danger is this guy. So if the dollar follows suit today, I think there comes pressure on that risk market. So that sort of dead cat bounce scenario, it's not the bear markets that hurt, it's the bear market rallies. We may be seeing that play out, so just be cautious there. All right, Katie asking if we can see the thing. I think he's signed off. He's just asked to take a look at the Nasdaq. So let's bring it up, and then I'll put this onto the Telegram, and he can catch up on the Telegram channel. But let's just bring up Nasdaq. Again, very strong week here. There's a lot of, let's clean this up. Let's take all of this out. Okay. So we can put in a support here. I think that's sort of the most obvious thing. Support level here is being defended. It just so happens that it's at the time that there is a pullback on the real rates. I think that if this support level goes, that's going to be quite devastating. We're not in the lower quintile yet, but I think the best way to look at this, KD, is again through the real rate. So instead of having US dollar chart, let's just throw in the Nasdaq. Okay, so this is the daily, and what we can do here, it might even be more useful to go down to the 4 hourly. But before we go into the 4 hourly, let's put in vertical here. Okay, so this is where we can get rid of the stochastic. This is where the real rate starts pulling back. This is also where the Nasdaq starts moving right. Again, I think the big deal now is what happened on the real rate yesterday. So that real rate now is complete potential higher trough. In other words, we've platform for a swing. I think that my feeling is we still got a ceiling on it until more of a moderation on the longer term. But if I'm wrong there, okay, and if the real rate does start developing into next impulse, then I think this leg over here is in danger of moving into the next impulse to the downside. Okay, so you can see the sort of the correlation here. Let's go down to the 4 hour. So in the 4 hour, this is a little bit more exact. So you can see how you can see on the 4 hour here, pull the real rate. Here is the Nasdaq responding because of that time value of money, right? We've done that many times previously. Of money, the inherent characteristics on Nasdaq, which is a growth index, makes it very sensitive to interest rates movements. Now, what's the anomaly here, Katie? What's the anomaly here? We've now got the real rates moving up, and this is being sort of resilient at the moment. So something's got to give. One would expect something's got to give. Either the real rates would need to move that way, okay, and that would support Nasdaq, or we would have to see Nasdaq. So just keep an eye on. All right. Any other questions? Any other questions, guys? Just a reminder, tomorrow we'll have that live trade live account. Everyone is certainly most welcome, and look forward to the third session today for our day trading workshop. And I think we'll wrap up here. Thank you very much, guys, and speak to you a bit later in the day.